Hey everyone, welcome back to TV5 News at 9. Time now for Aging in Style with American Retirement Advisors. And joining us now is President and owner Joe Vitale. Joe, it's good to see you. Thank you for calling in. How are you?
Doing great, Blake. Good morning. How are you?
Doing great as well. Thank you for asking. But before we dive in, don't forget about Joe's newsletter, Financial Vitals. You can scan the QR code right there on your screen for direct access and subscribe today for market and financial news and trends. On today's topic, navigating the fourth quarter. We made it. Significant global events, Joe, though, often intensify the changes we're already starting to gain motion. So let's look at what to expect in the fourth quarter. What suggestions do you have about tax planning, and what should we be doing right now to prepare?
You know, there's a lot of different things happening right now. This year, we've seen a lot of ups and downs in the market, and we're down 20 to 30% depending. So there's a lot of strategies that we can employ right now. A lot of people are like, oh my gosh, I can't do this. I've got huge capital gains, or I don't want to take a loss. You know, there's still strategies right now. We think we're going to have a positive fourth quarter. We're hoping we're going to. Traditionally, we should see something like that. But even if we don't, we're still looking at, you know, a lot of people are in the market. Now's not the time to pull out and say, I have to get out of the market now. That's the worst time. You want to stay the course. You want to make sure that you're in. But tax strategies, we've only got a couple months left now to take advantage of this. So part of it is, you know, we're going to talk about Roth conversions. We're going to talk about contributing. We're going to talk about qualified distributions. But we want to make sure, first and foremost, I want to get in touch with a lot of our clients. We're talking to their accountants to make sure that we know how much wiggle room we have right now, because we are still in the lowest tax environment we've ever seen. We've got another 4 years of this.
Yeah.
We don't know if it's going to keep going or if it's going to be repealed. So we want to make sure before it sunsets that we take advantage of any strategy we can.
Very good. And of course, you know, with charitable donations made throughout the year, what should we know about those contributions before or by the year's end?
That's something that everybody's like, oh my gosh, Joe, I can't take a tax write-off, right? Because of my deduction, I can't itemize.
Yeah.
But the one thing, a lot of clients in retirement, if they're 72 and they have to, or older, and they have to take the required minimum distribution, we actually have people say, Joe, I really don't want to take this distribution. I don't want to pay tax. And even if you're not 72, you don't want to pay tax on this. But if you are 72 or older, there's a qualified distribution, charitable contribution that you can make to the church or charity of your choice. You don't have to pay tax on that. So you can't write it off anyways, but why pay tax if you don't need it and you're going to contribute to church anyways? This way it goes directly to the church or charity. You don't have to pay tax on it, neither do they, and it's a qualified distribution. But if you're prior to that age and you don't need it, a lot of people are saying, I'm not ever going to touch my IRA until I have to because I don't want to pay tax. But you got to remember, right now we're in a low tax bracket environment. And if we can do strategies in a 12% tax bracket, we need to take care of that because it's going to go to 15 in 4 years.
Well, speaking of the income bracket, tax bracket, you talked about maximizing it. What does that mean? How does that change, though, when you're looking at the end of the year?
We want to, a lot of times, you know, you have up to 12% tax bracket if you're married filing jointly, up to like $80-some thousand. Well, if your income is only $30,000, granted, you don't want to pay tax on your Social Security, and if you have too much income, you'll pay tax on it. But if you're looking at the strategy and we can convert money from a taxable to tax-free and stay in a 15% tax bracket, we actually do the reports with the software showing you how much money you're going to save over time. A great example is we did a Roth conversion with somebody, a report showing you're going to pay maybe $40,000 with taxes, but if you keep it in the IRA and just take your distributions and moving forward, it's quadruple that in taxes. So we're able to save a lot of money just by being very smart with it, making sure that we pay tax at a lower tax bracket ahead of time as opposed to a lot more. You're paying tax on the seed, not the crop. So it's definitely something we need to look at.
Gotcha. Well, that was a great picture for you to paint. Thank you. So, Joe, what about year-end additions to IRAs and Roth IRAs or Roth conversions?
Right. Yeah. Right now, if you're still working and you haven't made your contributions, or if you're in a 401k and you can still contribute, you got up to $6,000-7,000 a year you can put in a Roth IRA. So we want to make sure you take care of that. Another thing is looking at our tax brackets. If we can do Roth conversions, we want to take care of that. You know, if we can maximize that tax bracket, and convert that into a Roth so it's all tax-free down the road, we want to do that because down the road, you're going to pay more tax on it. And if we can do it at a lower tax bracket, it makes all the sense in the world. There's other strategies with life insurance retirement programs that can grow tax-free as well. So we really want to have those discussions, looking at strategies that we can employ to create some tax-free income down the road and tax redistributions. And a lot of times people, they never want to do it, Then all of a sudden, like, oh my goodness, I wish I would have done this years ago. So we're trying to be very proactive right now.
Thank you for breaking it all down for us this morning. Joe, is there anything else you would like our viewers at home to know?
Anything you can, anytime you need, give us a call. We'd be glad to help you. We're doing a lot of this right now. It is labor intensive to do the Roth conversions. So some advisors do not want to do it, and it's not fun, but it's the right thing to do. We definitely want to be proactive. It also helps with beneficiary plannings down the road and income planning. And a lot of times people say, I'm going to leave my kids money down the road. Maybe you want to, maybe you don't want to. But here's the question. Do you want the money to go to Uncle Sam, to the government when you pass away, or do you want it to go to your kids? And if you don't do the strategies on the front end, you're going to leave a lot of taxable money in the back end. So we want to make sure we're very proactive with that.
Very good. Joe, I appreciate you. Thank you for calling in this morning.
My pleasure, Blake. Good to see you. Take care.
Good to see you, too. And don't forget about Joe's newsletter. And also, if you want more information on today's topic, just head on over to the Aging in Style page on our website, WNEM.com.